August 2019. Adam Neumann walks into WeWork's headquarters barefoot like he does most days, except this time nobody in the room is smiling. 3 weeks earlier, his company was worth $47 billion, more than Ford, more than General Motors, more than most countries' entire stock markets. Now, the number is falling by the hour, and it won't stop until it hits 44 million. Not 44 billion, 44 million. Keep that number in your head. We'll come back to it. Here's what makes this a strange story instead of just a sad one. It doesn't end with Neumann broke and forgotten. 3 years after WeWork nearly took him down with it, Andreessen Horowitz, the most feared venture firm in Silicon Valley, wrote him the largest single check the firm had put up behind one founder up to that point. $350 million for a new company, selling almost the same idea. So the real question here was never, how did WeWork collapse? Business schools already have that case study. The real question is how a man who burned through $47 billion convinced the smartest money in the world to hand him hundreds of millions more and got it. Read WeWork's early pitch decks, and you won't find much about subleasing office floors. You'll find phrases like elevate the world's consciousness. Actual language from actual investor materials. Neumann wasn't selling a rental company. He was selling a movement, and investors who might have laughed a landlord out of the room instead leaned in because nobody wants to be the one skeptic who missed the future. His wife, Rebecca, ran brand and culture and took the mission as seriously as he did. She launched WeGrow, a private school built around unleashing every child's superpower, and stood on stages at company festivals talking about consciousness and purpose while a few thousand employees cheered like it was a concert. And Adam himself wasn't shy about the scale of his ambition. The Wall Street Journal later reported he'd told people at various points that he intended to become the world's first trillionaire, that he wanted to be president of the world, that WeWork would expand to Mars, and that along the way he'd solve the problem of children growing up without parents and eradicate world hunger while he was at it. Nobody in the room laughed. That was the whole trick. Company-wide gatherings blurred into something closer to a revival than a staff meeting. Employees who might have asked hard questions about the balance sheet found themselves swept into a story that felt bigger than a job. And once people believe they're changing the world, asking for the actual numbers starts to feel almost rude. It worked on investors too. Mark Andreessen, a man who had spent 2 decades preaching that founders should be worshipped rather than managed, looked at Neumann's chaos and saw a feature, not a warning sign. The lease liabilities stacking up against short-term memberships, the math that never quite closed, none of it mattered as much as the story. Neumann wasn't just renting desks. He was, in his own words, changing how the world lived and worked. The view from the penthouse was extraordinary. Nobody was checking whether the foundation could hold it. Worth pausing on what the business actually was underneath all of it, because the mechanics matter. WeWork signed long leases on office buildings, 10, 15, 20 years, then chopped the space into desks and private suites and rented those out month to month, sometimes week to week. That gap between what you owe and what you collect is fine if you're a landlord who prices for it. It's a bomb with a long fuse if you're pitching yourself as a technology company and pricing like you're trying to buy the whole neighborhood before anyone else notices the opportunity. WeWork was doing the second thing at global scale on borrowed money while calling it disruption. Then came Masayoshi's son. In 2017, in the back of a car in New York, the SoftBank founder gave Neumann a few minutes and one question. Did he want to be smart or crazy? Neumann said crazy. Not long after, SoftBank put $4 billion behind him, the first slice of what would eventually total more than $10 billion, and the thing that pushed WeWork's valuation from $17 billion to $47 in barely 2 years. After that, WeWork stopped being a real estate company in any way Neumann would admit to. He called it a physical social network, a technology platform, a piece of humanity's collective consciousness. The money went everywhere: elementary schools, a wave pool company, private jets, a legal maneuver where Neumann trademarked the word "we" through an entity he personally controlled, then charged the company nearly $6 million. Tala sends it back. The board, which existed to say no to exactly this kind of thing, mostly said yes. By August 2019, that story met paperwork. WeWork filed to go public, and the registration document every company has to release before an IPO turned out to be less an invitation than a confession. The numbers were right there for anyone who wanted to read them. Losses of $430 million in 2016, climbing to $930 million the year after, then just under $2 billion in 2018 alone. Break that last figure down, and WeWork was losing something like $219,000 every hour, day and night, whether anyone rented a desk or not. 3 years. And the losses had grown roughly 4 times over, while the story stayed exactly the same. Wall Street read the filing over a weekend and reached the same verdict from every direction. This wasn't a technology company. It was a landlord with a mission statement and a burn rate, and no economics underneath the story. Within days, the $47 billion number was gone. Bankers cutting the estimate first to $20 billion, then, as Neumann's self-dealing in the filing kept surfacing, all the way down to 10. The IPO didn't fail so much as evaporate. Within weeks, the plan was shelved. Within a month, so was Neumann. SoftBank, sitting on a 9-figure-a-year problem it couldn't walk away from, forced him out that September and took control to keep the company from collapsing outright. Then came the part that still makes people angry at dinner parties. Neumann left with roughly $1.7 billion. Stock buybacks, consulting fees, loan forgiveness. The exact mechanics matter less than the headline. 2 months later, WeWork laid off 2,400 people, about a fifth of the entire company, as part of a $9.5 billion rescue deal that handed SoftBank roughly 80% ownership. Employees who'd taken stock instead of salary watched theirs go to zero. The man whose decisions caused all of it walked out closer to being a billionaire than he'd ever been. SoftBank, meanwhile, had to face what the rescue actually cost. By May 2020, Masayoshi Son got on a call with investors and said in plain words that his judgment had not been right, that he regretted it. SoftBank wrote down the WeWork investment by $4.7 billion, took a $6 billion loss for the quarter, its first quarterly loss in 14 years, and marked WeWork's value at $2.9 billion. From $47 billion to under $3 billion in less than a year, and the company hadn't even failed yet. It was just being priced like it was going to. That should have been the end of it. Humbled founder, chastened company, hard lesson learned. Except WeWork itself didn't survive either. 4 years later, in November 2023, the company Neumann built filed for Chapter 11, carrying somewhere between $10 and $50 billion in liabilities depending on whose estimate you trust. Its stock, still trading, fell to 84 cents a share. Total market value, $44.5 million. That's the number from the beginning of this story. What was left of $47 billion. Here's the detail that turns this from a sad footnote into something closer to dark comedy. Neumann tried to buy it back. During the bankruptcy proceedings, he offered roughly $500 million to reclaim the company that had pushed him out, the same company that had just told a federal court it couldn't pay its bills. The bid failed. WeWork emerged from bankruptcy in mid-2024 under new ownership, with over $4 billion in debt erased and a new CEO who'd spent his career in commercial real estate instead of consciousness raising. Neumann, meanwhile, wasn't sitting still. By the time WeWork was in bankruptcy court, Flow was already running. Its first property, a 639-unit building in Fort Lauderdale called Society Las Olas, opened with neon signs in the lobby. The same aesthetic touch that used to hang in WeWork common areas, just moved from an office building into an apartment complex. And the funding timeline here is almost too neat to be real. Andreessen Horowitz put that first $350 million into Flow back in 2022, while WeWork was still solvent and Neumann was still radioactive enough that most of the tech press treated the investment as a scandal on its own. Angel investor Jason Calacanis said it out loud at the time. A startup worth $1 billion before it has a product, he said, is probably a scam. Others pointed out the uncomfortable double standard, female founders with actual revenue struggling to raise a fraction of that, while Neumann, $4 billion of destroyed value behind him, got a 9-figure check on a pitch deck. Andreessen Horowitz backed him anyway. Then in April 2025, months after WeWork's bankruptcy had closed, Flow raised another $100 million, pushing its valuation to $2.5 billion. Added up, and Andreessen Horowitz alone has now put north of $450 million behind Adam Neumann's second act. Not in one check, but 2, 3 years apart. The second one arriving only after the first company he'd built on nearly identical logic went through bankruptcy court. If you want a historical parallel, you don't have to look far. In 1720, the South Sea Company sold British investors a story about untold riches from trade routes that barely existed, backed by government connections and a founder everyone wanted to believe in. It collapsed and took the savings of half the London gentry with it. What's strange isn't that it happened. What's strange is how little the pattern has changed since. Call it founder fundamentalism, if you want a name for it. The belief that certain people are so singularly gifted that their failures are just chapters in an eventual triumph, not evidence against one. Flow is, by design, close enough to WeWork that the comparison writes itself. Where WeWork sold community inside an office, Flow sells it inside an apartment building. Same neon signs, same pitch about belonging, same bet on a founder's ability to make people feel something a spreadsheet can't capture. Andreessen didn't avoid the parallel. He leaned into it. The wager was never that Neumann had changed. It was that the story he tells is worth more than the numbers underneath it, and that Silicon Valley would rather fund a familiar disaster with a great narrator than a boring success with a bad one. Whether that's redemption or amnesia probably depends on what Flow looks like in 5 years. But the $47 billion WeWork burned through didn't disappear because Neumann learned a lesson. It disappeared, and then somebody handed him a new number to try again with.